Okay, a warm welcome to all of you online to this webinar on CBDCs and payments. My name is Dirk Niepelt, representing CEPR's Research and Policy Network on Fintech and Digital Currencies. This is a joint event with the CEPR European Financial Architecture, RPN, and with SUERF and with SAFE. So there's 4 institutions involved today. We're talking about CBDCs and payments. As you know, recent research and also in the policy discussion, there has been a lot of emphasis on the effects on retail CBDC on banks, on financial intermediation, on financial stability. Today, we want to shift the focus a little bit towards the payments dimension. And we have 3 excellent speakers around to tell us more about that. We'll have Ulrich Bindseil from the ECB. We have Amiyatosh Purnanandam from Michigan, and we have Tobias Berg from Goethe. Tobias and Amiyatosh, they will present academic research together with their co-authors, and Ulrich will go first and will tell us a little bit about the ECB's current plans about the digital euro and how it relates to the payments dimension. Each of the 3 speakers will have 20 minutes sharp. We'll collect questions along the way. So if you have questions, then please enter them in the chat. I'll collect them. If there are super urgent questions of understanding, I'll try to raise them during the talks. Otherwise, we'll come back to your questions after 60 minutes when we have seen the 3 presentations. And finally, the slides, all the 3 slide decks will be made available after all on the RPN web pages of CEPR. So with this, a very warm welcome to the 3 speakers. Thank you very much for taking the time to talk to us today. And Ulrich, the floor is yours, please.
Yes, thank you, Dirk, for inviting me. And let me share my screen and go through my presentation. So as you say, I will be rather practical and focused on the case of the digital euro. And yeah, I really appreciated the framing of the seminar, the focus on means of payment issues relating to CBDC, because that fits well, at least for digital euro. Of course, digital euro doesn't put into question the 3 functions of money that Aristotle already saw, but we focus, I believe, in the design of digital euro on the means of payment element, and design digital euro in a way to discourage large-scale use as store of value of digital euro. And I also believe that there has been maybe an over-focus on macroeconomic consequences of CBDC. Of course, it's important to look into those, but I think at least under a design like the one of digital euro, the consequences, the macroeconomic consequences in terms of, let's say, conjunctural or structural financial implications will be limited, and any macroeconomic effect will be more linked to the general contribution of CBDC digital euro, in that case, to an efficient, up-to-date means of payment. But that is almost everything theoretical I want to say. Now I will talk on digital euro foundations. So how do we explain that we work on digital euro? On the left side here, the slide recalls that digital payments are on the rise. So just within 3 years, the share of cash payments in terms of number of transactions at the point of sale went down from 72 to 59%. Moreover, of course, online payments, online purchases are steeply increasing. Here it says 6 to 34% in this period, and they are fully digital by nature. And yeah, the share of card payments have been rising in particular as one instrument of digital payments. And central bank money is not part of this because, or it is part of the shrinking cash payments, because we don't have a digital means of payment in central bank money. And if you extrapolate the trend that we observe, of course, there will be less and less reliance on banknotes, and that is not likely to be a linear trend, but it can go very quickly, as we have seen in Sweden. But also other countries, cash payments can become very marginal because, yeah, once the network effects are lost, then it goes quickly. And it's not the intention of the ECB. So the ECB, baby is cash. It's only the ECB can issue cash. So therefore, of course, the ECB likes cash. It is the basis so far of the profitability of its balance sheet. But one has to face reality. Therefore, digital euro wants to preserve the role of central bank money in payments by offering, something that is in demand, offering digital payments, and complement banknotes in this respect, integrate that into modern payment trends, and basically, keeping euro fit for purpose in the future digital age. And that doesn't mean that we, overestimate ourselves and want to get now into the front line of distribution. We believe the industry is there to stay in this role. The private payment industry has developed, of course, countless skills and solutions and has capacity to deal with the front end. All this we don't have, so we have to approach this intelligently and leverage on the existing expertise and capacity. So first we have distribution should be via supervised payment services providers, a bit similarly to a four-party. I will come to for corner solutions in payments where banks distribute a payment instrument. We want here also banks and non-bank PSPs to distribute digital euro and have the client relationship, do the KYC, have the help desk for the clients. And PSPs would connect to digital euro using open standards. So I will come to that. Open standards, which we will define in the context of a rule book on which we work together with the industry. And also we want a healthy equilibrium, we say here, between central bank money and commercial bank money in terms of store of value. We don't want to change, let's say, the relative roles here, because some people, that was a maybe too popular topic at the beginning in the discussions, the assumption that everybody will shift to CBDC at the expense of deposits with banks. So although maybe this has been exaggerated as a fear, we think it's still good to have safeguards. So there will be different safeguards to avoid this to happen. So holding limits, no remuneration of digital euro, and what we call reverse waterfall, meaning you can pay with digital euro without warehousing it on a separate wallet, because it can be sourced with instantaneous direct debit from a commercial bank account, which will disincentivize people to hold digital euro as a stock. The digital euro will, as I mentioned, be an open, will be, the rule book will allow for openness and innovation. So it should offer a platform for innovation. Payments solutions for the customers have to be, flexible, agile, and innovate. And we don't want to prevent that by, we could have also offered a kind of closed loop solution. There are some such closed loop solutions which are just, from the settlement layer to the front end, predetermined by the single, holder of all those layers. But here it should be different. We have the settlement layer because it's central bank money. But the front end is based on open access of service providers and the ability to innovate, whereby we want, of course, to achieve certain policy objectives, like, for example, interoperability and pan-European reach, and that we have to impose via the rule book. So the rule book will combine the idea of an open platform with achieving the policy objectives. Yeah, rulebook development book group. Sorry, I mentioned it already a few times. So it would ensure the common standards, the policy objectives like pan-European reach and the harmonized payment experience, but give also the possible freedom to the industry to build solutions around that. And yeah, the rule book is not designed by us, with just internal work. We know that the industry has a lot of expertise, and therefore we have in the rulebook development all the key parties, the intermediaries, so the PSPs, the retailers, and the consumers in particular. Yeah, one topic that I also touched already on is the holding limit, and the holding limit, of course, would be the risk that the usability of digital euro as a means of payment is limited. The solution found to decouple the store of value or being able to limit the store of value function while letting the payment function unconstrained is this reverse waterfall. So the reverse waterfall, this instantaneous direct debit of your commercial bank account if you have linked it to a commercial bank account, which allows you to use digital euro in principle like PayPal. I don't want to name anyone, but everybody knows PayPal, and everybody knows that when you use PayPal, you don't warehouse deposits on your PayPal account. No, just use PayPal in e-commerce, and PayPal gives you a credit. No, it debits your account in some way 1 day later or 2 days later, and the digital euro would not give any credit. So we don't want to be in the business of credit provision. But we want to rely on instant payment technology, which has developed well over the last years. And so the idea is to allow for direct debits, and there would be no limit, or there could be a limit, or there will be a limit, sorry, but the limit is purely derived from a fraud prevention objectives. Fraud is a growing and important topic in all instant payments. So the only reason then to limit the means of payment is fraud, and we have to see, how such a limit is established. But it would be certainly higher than the limit that has been mentioned for the store of value function. So I mean, here I advertise two papers, one a bit longer one and a shorter one, on the fears, of bank disintermediation, why they are not so relevant with this design of digital euro, and why we believe there are no macroeconomic effects of digital euro, except the ones maybe of smoothening payments or contributing to digitalization, which should be a positive, supply a factor from a macroeconomic perspective. Of course, the legislation is important also for the design of digital euro, or partially it determines the design of digital euro for payment purposes. So Article 15.1 says a few things which are relevant. I mean, everything is relevant, so this is just an example. So every natural person and legal person should have access to use a digital euro. I'm not sure what the second point was referring to, but it refers to the need to be able to implement monetary policy and to preserve financial stability. And at the same time, so this, speaks in a certain way to constrain the store of value function, but then also it says that yeah, one has to preserve freedom of access to a public good as central bank money. So one should not just say, why don't you put the limit to €1 if you can solve everything with the reverse waterfall? Because the starting point should be the freedom to access central bank money, and constraints should only be set to the extent that they are necessary and not disproportionate. Yeah. So that is a bit the trade-off in setting the limits at the end. Offline digital euro is, I think, interesting. As you know, all the current private digital payment instruments are online now. There have been attempts to establish offline, notably in Germany, the Geldkarte, which was deployed with a lot of investments. And I think more than 15 million such cards were issued in Germany. But at the end, there was so little use of them that they were discontinued again. So they're not so clear what the demand for offline is, but digital euro will be offline, will have an offline function. Also, legislators are very strong on this. So the digital euro draft regulation from the Commission even prescribes that we offer offline digital euro at the same time as online digital euro from the very beginning, which is potentially constraining because online technology is much more known or tested every day, while offline is to be designed a bit from fresh. So yeah, what to say on this? So it will be there for person to person and point of sale, and it is as form factors. It will have the mobile, can be on a mobile device, mobile phone, and there will be smart cards, and in principle, both will be then usable for person to person and for a point of sale. The distribution of the devices, either of the cards, or then easier, of course, the mobile-based solution will also be for banks. So there's no difference there relative to online digital euro. The PSPs will play the role as distributor. And sorry, I thought I had one more. No. And yeah, this disappeared. Yeah, I thought I had one more slide on the security features and privacy. So the idea is that offline payments will also be particularly private in the sense that no data on the sender will be shared really. So it will be, I mean, everything will be designed to allow for a maximum of privacy / anonymity. The only constraint is, of course, fraud prevention again and forgery prevention. So as ECB, we are responsible for the integrity of the issuance, and we cannot, of course, tolerate forgery that at the end there will be digital euro created, spent several times, created in an offline environment, which is less controlled. And therefore, when the uploading and offloading of funds on the offline wallet will have to be always online, of course. And we will then have to see, and that is really work that is ongoing, what is the minimum data that is required when the offloading happens to check, to prevent basically fraud and printing, let's say, illegal forgery of digital euro. Yeah, but that's a principle of strict minimization. The idea is that offline payments are also highly associated with anonymity and will be subject to a limit and to keep the balance, of course, prevention of illicit payments also and money laundering. compensation model is a big topic in payments, of course, and the
Ulrich, you
idea.
have like 2 minutes, sorry
Yeah,
for being late.
absolutely. So the compensation model will be a four-party model, so close to the four-party model in card industry like Visa and MasterCard. So there is a merchant fee which is used to compensate the issuing bank um, and the acquiring bank, and the consumer is not charged. Of course, that's also in the legislation. And yeah, so the four-party model, I think, works well in practice, is tested. I mean, here a difference will be that the scheme owner, which is in this case the euro system, will not be compensated. The compensation of the euro system should be via seigniorage income from the issuance. So the merchant fee will be used exclusively to compensate the other, parts of the industry who will acquire or distribute digital euro. Yeah, there is no compensation to the scheme owner and to the owner of the settlement layer, which we are as well. Of course, very tricky is the setting of the merchant fee in the spirit of the rule book of a competitive open system. We don't want to prescribe the merchant fee exactly, but we want it to be low. So that's a good combination. So you end up with the idea of a maximum, and the draft regulation states that there will be a maximum will be set based on the most cost-efficient payment service providers who represent collectively 1/4 of digital euro distributed in a given year. I mean, if you hear that, of course, you may be frightened to, how to calculate that. And there are lots of challenges. And also the question, how will this ceiling impact then on the viability of the business model for those who are more expensive and so on. But everybody, I think, going deeper agrees that this is both the best we can do and that this is viable in principle. I mean, there are somewhat similar arrangements in some countries to set interchange fee maxima and so on. So it's not a completed untested territory. And I think, most believe that this is feasible and the best we can do as an approach.
Can you conclude, please? Oh,
yeah,
perfect.
Here we are. Thanks.
Thank you very much, Ulrich. Great for this introduction. I think there's a couple of points where you connect to the next two papers, actually, and we'll be able to discuss this later on. We have now first coming Amiyatosh, who will present research joined with Tamana Singh Dubey on can cashless payments spur economic growth. Amiyatosh, the floor is yours.
Thank you very much, Dirk, and thanks for having me here to present this work. This is joint work with one of my PhD students, Tamana Singh Dubey. And this builds on the idea of digital payments that, of course, Ulrich has nicely set the stage for. So the broad idea that that around the world, we are experimenting with changing the means of payment. Given the presentation we just saw, I'll skip the motivational side of any seminar talk. I'll just say this, that across the world, and certainly in large economies like in India, like in Brazil, you have a massive change in the way retail transactions are happening in terms of the payments. And in the US, recently, we have launched FedNow. It has not been as successful as UPI or PIX, but today I'll talk about UPI. And I'll talk about one fundamental question that goes back to all debate on the role of money in economic growth. And to be precise, the question is, can the means of payment affect economic outcomes? Or is it merely a sideshow where whether I pay somebody in cash or by credit card or a cashless digital payment, at the end of the day, perhaps we are simply accounting for exchanging value, or is it that this method of means of payment affects economic outcomes? Now, it goes back to the basic idea that what kind of frictions are we talking about, and can the means of payment impact those frictions? If that were the case, then indeed we'll have a case to make theoretically, and of course I'm going to show you empirically, that if you move from a cash-based society, as largely India was 10, 15, 7 years ago, to a digital payment system, and I'll talk a lot about what the system is. In fact, I'll spend good 5 to 7 minutes of my talk giving you a broad overview of what has happened in India. And then we'll think about two key frictions: transactions cost, and think of that as lower cost of receiving and selling payment. Think about a small hawkers, as they call it in India, or a cart shop, a small shop. Now they can accept this payment pretty quickly from any retail consumers. So the speed, the safety, the supply chain constraint comes down. If there are 10 people, 10 links in the supply chain, and money is moving fast, instantaneously, at every point in supply chain, then the money that is locked in has come down. Working capital has come down. So all of that, we're going to be calling them transactions cost. And the second part is that when you pay with digital means of payment, it leaves a digital footprint. It solves some sort of information problem. And broadly, you'll think about, well, if I have better information, if you can see my payment history, then you as a bank perhaps are more willing to give me credit. Your screening cost has come down. In fact, in India, we have talked to quite a few people who are in this space, and the way we phrase it, that digital means of payment enhances the contracting space, by which I mean the kind of contract a lender can write for the borrower. You can tailor your debt repayment to the cash flow pattern of the borrower. You can, and finally, you can enforce these credit contracts better because you have better information, lower monitoring costs, and so on. So when you have these frictions, there's a case to be made that by changing the means of payment from cash to digital, you end up with economic growth. And we are going to be testing that hypothesis on digital payments in India. Let me take a few minutes to talk about what really happened. A little bit of a history, quick. A lot has happened. So this is my attempt at synthesizing everything into 2 slides. So let's start looking at the end of this timeline. Digital payment system in India is called UPI, Unified Payment Interface. And that was launched in 2016, late 2016. And of course, now I'll show you some numbers. There are billions of transactions happening there every month. But this happened because the seeds of this were sowed about 7, 8, 10 years ago. And there are 3 fundamental things that led to this culmination of the launch of UPI, which allowed everybody to pay, all the retail consumers and the shopkeepers to accept and receive payments through a mobile phone. And what happened is that way back in 2009 and 2010, India launched a scheme of giving every citizen, billion-plus citizen, a unique identity card, a biometric-based identity card. It's called Aadhaar card, which is a Hindi term for foundational card. Okay. So this was a very ambitious program launched by what I'll call a lot of software gurus sitting in Bangalore. And finally, they pulled it off. Over the next 5, 6 years, practically everybody got covered under UPI. So now everybody has an ID. And in 2014, the government opened a bank account, again, practically for everyone. So 500 million new accounts were opened under this scheme called Jan Dhan scheme. Again, it's a Hindi word for wealth and money scheme. That's what it means. But now what you have by 2014, everybody has an ID. So the verification and fraud, the issue that Ulrich was really talking about, when you think about means of payment, you worry about that. That risk has come down by a lot. The KYC, that somebody opens an account with a bank, now you're very sure about the authenticity of that account, relatively speaking. And what is not on my slide, around that time, you had a massive boom on internet mobile penetration. So these are the confluence of three things that led to what I'm showing you here, UPI. So you have everybody practically with a mobile phone, everybody has an identity card, and then you have everybody with a bank account. With that came what I'm showing you, the UPI system here. I'll be quick in the interest of time, but what I'm showing you here is that UPI is in the center of this graph. They are clearing the transaction, and the clearance is happening there. And then there are private parties. And that is one big difference that I see between the US and India, that the system was set up by the private-public partnership called NPCI, National Payment Corporation of India. They run this grid. So think of this as a highway of payment system, but they have allowed a lot of other private parties to connect to that highway. And these are the PSPs. So these are the folks like Google Pay. These are the folks like Phone Pay. And they are the ones, they become in turn, they take you to the household. So they are the ones that are connecting to the street numbers. That's the analogy I like to give. So in the process, what happened, if you have a mobile phone, in my example here, there is a receiver's bank, there is a payer's bank. And when I pay somebody, I go to this phone app and I say that I want to pay Dirk some money. And then both of us have a virtual payment address through that app. And so I make that request. My bank puts it on the UPI grid almost 24/7. And then immediately, the fact that I want to pay to Dirk and Dirk has to receive it gets verified because of all these, the verification that has happened in the backend. And his account gets credited right there, right then and there, right? And then settlement keeps happening at a periodic time. So this is the basic structure. And you see on the right, I'm showing you what we call a push card or a hawker in India, that if you have visited India recently, this is a common sight, that you'll have these folks, they don't have now big MasterCard or Visa or cash system. You just swipe your phone card on this QR code and the whole transaction is happening through cashless amount. All right, so here is the number. Let me get into the details now. So on the left side, you see the growth in the number and the volume of transactions per month. And I have converted that into the billions of US dollar. You're looking at you're looking at about $180 billion per month. It's still growing a lot, but already it is a lot in terms of even in terms of the payment volume. And of course, the growth has been exponential. On the other side, you see, I'll show you 3-4 graphs. I'll show you 3-4 graphs that will get you to my identification strategy and the empirical work that I'll be showing you later. So on the right, you see the number of participating banks. In India, the banking sector is dominated by about 40-45 large banks. And then you have a lot of small banks called cooperative banks. So what you see, not every bank participated on the UPI at the same time. So UPI was launched. So now system is there. And banks came at slightly different point in time. Now everybody is there. But in the early part, there was a big change in the way some banks adopted early, some banks adopted it later. That's where our identification in this paper will come. That is, we'll be comparing the impact of digital payments in districts where banks came in early versus where banks came in late. So now, same graph now, but I'm presenting same graph on the left, but now I'm adding district by district variation in that. So you have on the growth in digital payment, but this time series variation, there's a lot of cross-sectional variation that as you see. So all the darker the green dot, it means that on average, from 2016 till 2022, when we have our data, the average digital payment per person in those districts is very high. Whiter the shade, then the average payment is low. Point being, there's a lot of cross-sectional variation, a lot of time series variation, and this is what we're going to be exploiting in our empirical test. And finally, another summary stat. Now, you see in the green, the intensity of digital payment. And now next to that is the distribution, again, on a district by district basis of formal brick and mortar banking institution, number of bank branches per person. Notice two things. Lot of cross-sectional heterogeneity, but not a complete overlap. In fact, what has happened in India, there are a lot of dark green places, what we call in the heartland of India, which is, if you can see my where my cursor is headed, but these are relatively underdeveloped parts of the country from the traditional brick and mortar sense. And I saw in the chat box, there was a question for Ulrich that what it means for the underprivileged. And in fact, I'll show you that in India, this has really reached masses at places where traditional financial system did not reach. Mobile phone could reach there, digital payments could reach there. So with that setting, let me just, in the interest of time, I'll skip the data set. I'll just say one thing. We have very rich survey data at a household level, a small business household who are doing salaries, wages, small businesses from 2014 to 2022, and that's the data that I'm using, and a bunch of other things. I'll just show you the results and then talk about data as I go along, just in the interest of time. All right. So first, what we find, what you're seeing here is that for the entire country at a district level, so the treatment is at the district level, that is, you have the data on how much is the intensity of digital payment in a district in a quarter, and the outcome variable is the income of a household in that quarter in column 1. What you see, and these are the lagged, the forecasting regression, that what we're seeing here is that with household fixed effect, year quarter fixed effect, stroking away those obvious sources of heterogeneity, districts where you see more digital payments ended up having higher income. So this is log elasticity of 0.08, which is large. Number 2, you see how many of them have business ownership. So this idea that did it lead to business creation by relaxing that payment constraint. And you see that indeed in areas where there's more digital payment, there's more business creation. And finally, you see there is more business income that these guys are generating from business, more of that in areas with high digital payments. So these are correlations. What this is telling you is that in places where more digital transaction happen, you end up seeing more income, more business income. And of course, the key thing is it causal or is it simply a correlation? In the sense, is it simply that areas that are growing, you have all of that happening? Or is it something causal? And we believe we have something very interesting by exploiting the timing of bank participation that I had talked to you about. So this figure hopefully will get you to my key identification strategy. And Dirk, I hope I have 5 minutes if I'll plan my timing accordingly. Thank you. So this is the map of one of the central states in India called Madhya Pradesh, MP. And you see, and these are different districts, and different color means who is the lead bank of that district. So a little bit of history of Indian banking, that in 1969, the government of India appointed one government-owned bank to be the lead bank of every district. That bank, even though it happened in 1969, that bank is still the dominant bank in that district, holding 35% market share. So now, so this is historical. Now, here you see that in green, there are these banks that came on UPI early. And in this blue shade, there are banks that came on UPI a little bit later. So the difference in participation, so folks who are in this districts, green districts, they could join UPI early. Those who are in blue, they had to wait for some time. But the thing is that this timing participation, there is something very unique here. This was launched in 2016. And in my example, green banks, by November of 2016, they were offering their customers UPI. The blue banks were not on UPI in November of 2016. And why am I talking about November of 2016? This was a very unique month in India's macroeconomic policy. Demonetization of high denomination currency notes happened at that time. So in 2016 November, those who were in the green district, demonetization quickly was a shock that made a lot of currency no longer a legal tender. So you had to go to the bank, and then if you're carrying cash, then you have to exchange that cash for new cash. So there was a lot of friction now. So a lot of folks in the green district, they started using UPI because there was no such restriction on that. Your money was going from bank account to bank account. So because of that, what happened here, that we call the early adopter and the late adopter district, that is whether your lead bank district had adopted the UPI before or after 2016, even though the difference was only about 6, 7, 9, 10 months, depending on which district you're talking about, it happened at a time when demonetization shock happened. And because of, again, the network externality that Ulrich was also talking about, what I'll show you that once you start early in a district, and it's a peer effect. If I start making digital payment and I send to Tobias and Tobias sends it to Dirk, then our network starts using it a lot. In fact, what we find is, let me just show you this, that on a matched sample of districts, over time, the red are the districts where the UPI was launched earlier, before November 2016. There remains a 15 to 25% difference over a long period of time, very consistent with the network externality model. So one of the lessons that I think if any other country just thinking about looking at this slide is that network externality is very strong in the adoption of digital payments. So those who start early, those areas that start early, will see the benefits early for a longer period of time. But empirically, this is the variation that we get across early and late adopter districts. And this is the exogenous, what we call the instrument that we are now going to compare outcomes across these two districts and relate it to the digital payment outcome. So what we find, I'll just show you a graph, a difference in difference graph, where what you see is that what was the differential income in 2 minutes, thank you. What are the differential incomes for the households across early and late district? And this vertical line is the launch of UPI. Before that, these two districts had very similar income. There was nothing really differentiating the two. And over time, you see, these are the quarter by quarter regression coefficient that you see about 5, 6, 7, 8% increase in digital payment. In fact, the 2 quarters when you see no difference is the quarter of lockdown in India, when if you're not going, COVID lockdown, I mean, if you're not going out, you're not buying anything and the transaction came down. All right. So this is what we show in the regression, that about 7.8% increase in income, 1.03% increase in business creation in early adopter district compared to late adopter district. All right, the final thing I'll show you, and then I'll stop here, is that now what we do is we look at who really benefited from that. And so this hawker, these are the marginal holders. These are the marginal households. And what we find is these are the folks where the benefit was the most. And in the interest of time, I'll show you simply say this, that the effects are stronger in districts with weaker traditional financial development. It's stronger for households that are marginal. And finally, what we show is that the borrowing quantity went up in those districts. Districts where digital payment came, very consistent with the first slide that I was showing you, that it cuts down the transaction cost, improves the information footprint, and therefore the quality of borrowing goes up. In fact, relates to one of the papers that Tobias has, he'll be speaking next, but one of his earlier papers, that once you have the payment history, you can create credit. So I'll stop here. And finally, there are a lot of interesting stuff in the paper, such that we use the nightlight data from the IMF to show that, look, it's not only the formal economy, that overall this has gone up, consumption has gone up, and RBI's data on credit creation has gone up. In the interest of time, I'll stop here. Thank you very much.
Well, Amiyatosh, thanks very much. Great. Also, thanks so much for already taking care of one of the questions in the chat or in the Q&As. And we move on to Tobias, who will present his work with Jan Keil, Felix Martini, and Manju Puri on CBDCs, payment firms, and geopolitics, which will lead us a little bit back now towards Europe, I understand, in the perspective that Tobias is taking. Tobias, floor is yours. Thank you. Tobias, you're still muted. You're muted.
Sorry, now again. So thanks for the introduction. And indeed, the paper is joint work with Jan Keil, Felix Martini, and Manju Puri. And let me give you kind of the key takeaway right at the beginning. What we are actually doing is we test capital market reactions to announcements on one of the key CBDCs, the digital euro. And we find that the digital euro is mostly about the medium exchange function, not about the store value function, so quite nicely linking to Ulrich's arguments. And number two, it has a geopolitical dimension. So US firms are opposed to it. They see negative capital market reactions, whereas European payment firms seem to benefit from it. I think in this round, I don't need to motivate CBDCs and payments. So there are many countries worldwide who explore CBDCs, and the central bank digital currency at its heart, first of all, is a direct liability of the central bank. I'll be talking about a retail CBDC, so one that can be accessed by households. And apart from the traditional unit of value function, obviously, you could discuss both the store of value function, which has been done a lot in the existing literature, like disintermediation of banks, if you can deposit money in a CBDC, and the medium of exchange function, which mainly affects those intermediaries that provide payment services. So what we are doing is we're looking at both banks and payment firms from both the US and from Europe and see how they react to certain important digital euro events and announcements. And the first channel is actually how to identify payment firms. And we all know payment firms, maybe Visa, MasterCard, PayPal, but how do you identify these firms in a structural manner in a large-scale data set? So for commercial banks, it's easy. SIC code sticks 0. Payment firms don't have their separate industry codes typically. So we develop a method which should also help beyond our paper to actually identify payment firms, as we argue, in a quite clean manner. Yeah. Now, payment firms are actually pretty large. So if you look at the US, the market capitalization of all firms that we call payment firms is actually approximately 70% of the market capitalizations of the entire commercial banking sector in the United States. So to give you some names attached to it, this would be in the US, Visa, MasterCard, American Express, PayPal, Fiserv, FIS, and so on. And if you compare that to the commercial banks here in the second column, you see that, yeah, Visa is actually bigger than JP Morgan, MasterCard is bigger, slightly bigger than Bank of America. So these are all firms with a quite significant market capitalization. And one of the reasons is that most economies worldwide spend between 1% and 2% for payment services. So the payment industry is a quite big industry with quite significant cost also for the consumer in the end. If you look at the Eurozone, these firms are obviously smaller, but for example, the biggest firm in the Eurozone, Adyen, a Dutch payment firm, would be the third or fourth largest commercial bank if you put it in the rank of commercial banks, depending exactly on the time you use. So even in Europe, these largest payment firms like Adyen are quite sizable also relative to the commercial banks. Now, what we are doing is pretty simple in the end. We are doing event study to CBDC announcements on the digital euro. And we first of all rely on a BIS database that collects all central bank speeches and also includes a sentiment indicator for each speech. So is this speech more positive about the digital euro? Is it negative about the introduction of a digital euro, or is it neutral? These are all speeches, obviously, by leading figures from key central banks, the ECB, or the national central banks in the Eurozone. And we look at the period from 2016 to 2022. Implicit in this exercise is the assumption that information from central bank speeches is not leaked ex ante, but that kind of key information about the introduction of the digital euro is indeed conveyed via speeches. And we back up these assumptions in our paper if you want to have a little bit more details. Now, let me show the development of the sentiment of digital euro speeches. So these are mainly speeches either by ECB board members or by the key central banks, France, Germany, Spain, or Italy here, plus some of the smaller ones. And at the beginning in 2016-17, these speeches were mostly neutral, just laying out the topic and the concept of a CBDC, or even negative, saying we currently don't really see a use case for this. And this shifted in 2020, 2021. Speeches became more and more positive, and nowadays, most speeches actually have a positive stance on the digital euro. Now, what we do now is a standard event study. How do certain banks and payment firms react to positive news about the digital euro? So let me go back here. We could actually also test negative news, but the negative news were mostly at the beginning. So there was not a lot updating of priors if you didn't expect it anyway. So most of our data set will kind of include a comparison of positive versus kind of neutral speeches on the digital euro. Okay. And we focus on 4 key samples: US payment firms like Visa, MasterCard, and PayPal, Eurozone payment firms like, for example, Adyen, or Worldline, US banks, and Eurozone banks. Now, this is the key result here for the US payment firms. So US payment firms, no matter which kind of asset pricing model you use, see on average a 90 basis point negative reaction to positive sentiment speeches on the digital euro. Okay, this is not because it's a speech about payments. If you just do this as a placebo test, so to say, for neutral speeches, you don't find this negative effect. So this is concentrated in those speeches that actually have a positive stance on the digital euro, so that support the introduction or early introduction of a digital euro. You can do the same for Eurozone payment firms. And interestingly, the reaction is exactly the opposite. Eurozone payment firms actually benefit from positive stance speeches on the digital euro. So this suggests it's not just about new payment rails where maybe private sector firms suffer, but the US private sector firms see negative announcement returns, while the European private sector payment firms see positive announcement returns. And if you aggregate this up, so this is a cumulative announcement return graph that only looks at those days and cumulates these up where there have been positive announcements on the digital euro, you see accumulative positive announcement returns for European firms of a little bit more than 30%, and a cumulative negative announcement return for US payment firms of a little bit more than 10%. Okay? Now, we have to take into account, obviously, that US payment firms are much bigger. So if you convert this into billion euros, we estimate a loss of market capitalization for US payment firms of 127 billion, while the European payment firms gain 23 billion in market cap. Now, you can do the same for banks, and you find negligible results. Okay, for the US banks, I think this is pretty obvious. They hold very little euro-denominated deposits. They do rather little retail transactions or earn fees from retail payments in Europe. But even for the banks, even though the error margin or the standard error is a little bit wider, we don't find a significant effect for Eurozone banks. Okay, so this suggests that the digital euro is mostly actually affecting payment firms to a significant extent, and differently for the US payment firms who suffer to the European payment firms who stand to benefit from an introduction of the digital euro. Now, as usual in these type of event study settings, you can debate a long time about different factor models, a 3-factor, 6-factor market model, about wins rising or not, about which types of controls and fixed effects you use, and how exactly you define banks and payment firms. Okay, so we run in total 2,592 different regression specifications that mix up or combine all the different modeling choices that you might have in your head that we received as comments during seminars and the like. And you see the distribution of the key parameter estimate here for these 2,592 different kind of model choices you can have here for the benchmark asset pricing model. And you see in all and each of these 2,592 specifications, there's a negative return for US payment firms and a positive return for Eurozone payment firms. Now, you can exploit heterogeneity, and there's a lot of more detail on this in the paper, but let me quickly give you the key arguments here. When we focus on US payment firms that have a purely domestic focus, so not Visa and MasterCard, but a couple of smaller, let's say, unknown ones that purely focus on the US market, we don't find any significant announcement effect. Okay, this suggests it's not correlated with negative news for US payment markets in general on that day, because we see that only those firms that are actually internationally active react to these announcements. We also find that results are stronger for what we label pure play payment firms, such as Visa, MasterCard, PayPal, or Fiserv, than for what we label diversified payment firms. So for those of you who know the details about these credit card models, American Express and Discover stand out a little bit because they are also directly lending to the consumers that have their credit cards, versus for others like Visa and MasterCard, this is done by the issuing bank. And so for these firms that are also involved in the lending business, for whom kind of the fees from payment service might be a small amount of their total revenue shares, Discover and American Express, we find a muted response. In Europe, our results are also not driven by Wirecard. You might worry, for example, about this one. Wirecard obviously had wild stock market gyrations because it was involved in the accounting scandal. But the results are also weaker for Ingenico, which is a producer of hardware terminals, and it's not really clear to see why this should be heavily. We can also look at the cross-section of speeches. In our baseline sample, we have 69 speeches. Some of them have extremely generic titles like discussion of an annual report, where might be a side sentence on the digital euro. And we also categorize chronologically each speech to really see, does this speech actually provide new information, new positive information? To give you just one example, there might be speeches that are very much positive, but relative to what they've said before, they might actually even say, we think it comes a quarter, a year later than earlier expected, but we are strongly for it and it will come. These speeches, the BIS would classify as positive stance speeches, but we'll just look at the incremental news content. And then we find that our results that I've shown you are almost entirely driven by kind of half of the speeches, 34 out of 69, that contain most of the news content. So overall, results are stronger when you would reasonably expect them to be stronger in the cross-section of firms or in the cross-section of speeches. Now, last but not least, we provide supporting evidence from textual analysis of annual reports, media reports, and similar documents. Okay. Now, first of all, you see a lot of speeches by ECB members, but also European Parliament members who explicitly discuss strategic autonomy. Fabio Panetta said a digital euro would increase the efficiency of European payments and contribute to Europe's strategic autonomy. If you look at the EU commissioner responsible for this area, he says Europe's current payment systems are national, international. We don't have truly European options and are over-reliant on companies such as Visa, MasterCard, and PayPal. So these companies are even singled out in these speeches. If you look at press reports, after the Digital Euro Advisory Panel, so that's an advisory panel of payment experts at the ECB was set up, it said ECB shuns Visa, MasterCard, PayPal for Digital Euro Advisory Panel. And we show that more than 90% of the members of this panel actually come from European firms, mainly European payment firms. And the classical kind of payment firms that dominate payment here in Europe, Visa, MasterCard, PayPal, they are not part of this advisory panel. You can also look at company applications. So MasterCard said in 2023, we are particularly concerned that the proposal to establish a digital euro has gone beyond its stated objective of providing individuals and businesses with a digital form of central bank money, and just the store of value, so to say. Instead, the proposal seeks to create a duplicative, non-market-led payment system that calls into question the European Union's established approach to an open market economy with free competition. Now, if you look at similar statements by European companies, you might worry, what do they think actually about a duplicative, non-market-led payment system? And they're quite happy about it, actually. So Worldline, for example, says, as a recognized payment leader, we are committed to play an increasingly visible role at the pan-European level as we support at different levels major developments such as the European Payment Initiative or the digital euro. So we have the announcement study returns or findings that we see. They are also reflected in the statements if you browse through any reports or other comment forums by these banks and payment firms. And last but not least, what do the merchants think about this? There is a merchant association called E-Commerce Europe that represents more than 150,000 merchants in Europe. And they clearly support the digital euro, saying the digital euro has the potential to transform European payments, increasing efficiency, promoting innovation, and placing Europe at the forefront of payment technology. They also complain that they're currently limited in their ability to negotiate fair terms. So on average, at least worldwide, if you use PayPal, merchants pay 2.01% in fees for a single transaction. So many merchants complain about a lack of pricing power from their side vis-a-vis these payment giants and a lack of ability to negotiate what they think are fair terms. If you look at the profit margins of these bigger US firms, they typically have market to book ratios far beyond 5 and profit margins beyond 50%. And so this e-commerce association says merchants stand to benefit from lower costs. And this is, if I come back to our key result, our key numbers, also a little bit what we find, that there is a big loss in market capitalization for US firms. We estimate roughly 127 billion. There's a gain for European firms, a little bit more than 20 billion. That doesn't make up the whole shortfall. So there's a certain margin that the digital euro might still squeeze out for the payment sector in general. I'll skip this one in the interest of time and conclude. So for positive speeches on the digital euro, we find that stock prices of US payment firms decrease, of Eurozone payment firms increase, and for banks, we do not observe a significant reaction. And so the high-level findings is that the digital euro is mainly about the medium of exchange function, at least when it comes to the impact on financial intermediaries. And it also highlights this novel geopolitical dimension of CBDCs. Payment infrastructures are part of the critical infrastructure of every economy. And there is an increased willingness to actually look at the autonomy in this part and see whether a local solution can be found. So enhancing autonomies in payments, this critical infrastructure that we all rely on day to day. Thank you.
Great, Tobias. Thanks very much. So I invite the audience to submit questions to the Q&A or to the chat, and I'll try to bundle them. But in the meantime, until we get them, I take the privilege and start asking a couple of questions myself. So I'd like to ask Amiyatosh first. You had this, I think, very convincing notion of two different costs or two different frictions that are being relaxed, right? On the one hand, transaction costs being lowered. On the other hand, credit being eased to some extent for small entrepreneurs. So can you tell us a little bit more maybe about the second channel? How exactly does it work? How is this information being provided to other members in the payment sphere? If I buy something from you and I actually repay you, how do the other people learn about that? How does it work really?
So a great question, Dirk. There has been a whole ecosystem of fintech lenders coming up in India, and there is a huge growth on that front. So one is that there are these fintech lenders, as they call, and they will have a funding tie-up with non-bank finance companies, which are non-bank intermediaries. And what these guys do, it's like they'll set up. So we have talked to some of these folks. So one model is, there are many models. I'll just give you a flavor. One model is, I'll go and I'll set up, you're a small tea shop, I'll set up a payment system for you. So there are these intermediaries who are providing this service to you, and they just manage your whole transaction, just like Block or Square is doing in the US. So once I have that terminal, I get to see your payment flow. Then I can lend against that. So there are these companies that are directly lending, and they in turn are getting their funds from banks and NBFC. So there's this whole layer of intermediaries that have come up that I didn't get time to talk about. So they are doing that. Now, there is a whole lot of now tie-up that some of these guys, the payment services guys, where the payment flows. So remember, everywhere there is a app that I'm using. So PhonePe, Walmart subsidiary, is the market leader. So when I'm going, then PhonePe gets to see all my transactions. So they have that data. Now, so many times, in fact, there was recently one of the big lenders, Paytm, they have a bank also, subsidiary bank. So there is a little bit of a legal issue going on that front, but even that mechanism is there. So there is a direct fintech lending, there is the information sharing in terms of the bank network. And so on. If I may, quickly, there is another new thing that is coming up, which is very exciting in India. It's not yet operational, but it's a concept of account aggregator, where you as the user will have the authority to release all this information to any bank that you want to. So there will be one party that is collecting all the information, and it's all going to be run with code such that it's anonymous till you decide that I want to share that information with Bank of America. And then Bank of America can see all the information and lend against that. That is not happening yet. What is happening is the first two channels that I talked about.
Thank you very much. We have questions coming in, and we won't forget them. Let me ask one more thing, because before I go to the questions, again, relating to Amiyatosh's talk and then linking to Tobias and maybe also Ulrich. So if I understand correctly, you speculate or you argue, Amiyatosh, sorry, that in India it was really driven by the internet, the digital identity, and the account for everybody, the financial inclusion sort of aspect that made a difference. Competition was not an issue whatsoever. At least you didn't mention it, I think. While in the digital euro context, if I understand Ulrich correctly and Tobias also, then this seems to be, I guess, the main driver. Is that a, so to the three of you, is that the correct perception that you're sort of really talking about very different channels in that respect?
So quickly in India, what was happening is that, and this is a very interesting question, so I'll not have a complete answer, but I'll just give you the context of what happened. And that is in India, this NPCI, the National Payments Corporation of India, that operates this the payment system, is a government-private partnership. So a lot of banks early on, they are part of that system. And many of these banks are government-owned banks. So there was no mandate that they have to join this network, but it happened because of the context that I gave you, that many of them are government-owned banks, and at the same time, they had a stake in NPCI, okay? Whereas in Brazil, they were mandated that everybody had to join. So Brazil also took off like crazy. In the US, it's like on the other extreme where in Brazil, it was mandated. In India, it was a little bit of a persuasion. And it goes back to that. So the whole competition thing, initially you start doing that. And I believe it's a positive sum game even for the banks because they're reaching folks that they had never reached before. So there is a more expansion of that credit frontier where I feel like it's very costly for you to do the brick and mortar banking. In the US, you have neither. So I'm not surprised that take-up is almost non-existent on Fed now as yet, because the traditional banks have no incentive at some level. I'll stop here.
Okay, so on take-up, we have a question by Todd Keister that is targeted to Ulrich, and there was another one on Ulrich. So let's just collect those two for Ulrich. First one is, would businesses without a digital euro account be able to receive CBDC payments, and how? And then this other question by Todd, how would we measure success for a digital euro? Suppose take-up is going to be not that high, would that be okay? And maybe just because it affects the competitive landscape and that's enough, or do we really hope for a large take-up of a digital euro to make that a success?
Yeah, thanks, Dirk, and thanks, Todd, for joining and for your question. So the digital euro should be legal tender, and there should be an obligation to accept it. Every merchant who accepts digital payments must accept digital euro. So in this sense, you need to find a solution to accept it. And you need in principle a PSP normally to then also, as a sort of acquiring bank to allow you this, yeah. So that is mandatory if you accept other electronic means of payments, as almost everyone does. And the success, it's true that there are in principle positive effects just from the extra competition, but we believe that this doesn't really work for a means of payment because credibility, is only achieved if you have a large-scale successful deployment. No, so we don't believe we can just have a marginal take-up and that we will have positive policy effects with that. And we say in the field of store of value, we can constrain, we can, put a limit, and that gives us mathematically a maximum, call it market share, in terms of store of value function relative to what the banks have. In the field of payments, it's of course less easy, to say, yeah, I want a significant market share, but I don't want to crowd out excessively private payment instruments either. So, finding there the equilibrium is not trivial, certainly. But my feeling is that we should be ambitious and not believe, that the main risk is to crowd out everyone, but more be worried that we have insufficient success. So we should really make every effort to be successful and to get a significant market share. And let's see how far this gets us. But we should not remain marginal there. I'm convinced we have to try hard, be aggressive.
Thank you, Ulrich. We have a question from Agnes Benassi-Correa to Tobias about whether we could also sort of broaden the perspective and not only look at the market value implications of these digital euro news for financial corporations, but also for, Agnes mentions, big retail firms in the euro area. Maybe that's the next paper, or maybe you want to speculate a little bit already about that. And if you were to speculate, I would also have something else that you might want to speculate about, just to understand the numbers that you reported. You reported like 120 billion losses, if I remember correctly, for the US payment sector and smaller gains for the European payment firms. Would that lead you to argue maybe that the difference could be consumer surplus or something of that sort, or is that too far to go?
First of all, thanks for the suggestion on the merchant. So it's an interesting idea. I would expect a positive reaction for them. A little bit of a challenge is that obviously the benefits of the digital euro will be broadly dispersed to many small merchants versus kind of the direct effects on financial intermediary. They're very much concentrated in US and European payment firms, and therefore much easier to identify from a statistical perspective. So this on the merchant side. And then your question, Dirk, was how to interpret kind of the difference between the minus 120 billion for US payment firms and the plus 20 and something billion for European payment firms. I think there are two interpretations. The one is this is consumer surplus, because currently these US payment firms indeed have market to book ratios above 5, enjoy very wide margins. And the other one is that we're missing some of the private payment firms which are not publicly listed. And the latter part is an issue in the Eurozone. So the European Payment Initiative, for example, is currently not publicly listed, but is likely to play a significant role in the distribution of the digital euro. And we have a couple of other firms, think about Klarna in Sweden, which have a very high kind of implied market cap or valuation based on last funding rounds, but are simply not publicly listed. So that's the other thing, that simply in the Eurozone, not all payment firms are publicly listed. I think the truth is probably somewhere in the middle. And I think the interesting part where we'll get to, and I think this is a commonality also between India and the Eurozone, is that there's a big debate about the size of the interchange fees that these types of payment systems should attract. UPI was fully free of charge at the beginning, but now after pressure from these payment service providers, attracts a charge between 0.5 and 1.1% on certain types of transactions. And I see Ulrich's presentation also pointing to that this is still up for debate. How high should these fees be? And it's pretty clear that, merchants and payment service providers are probably on the other side of the arguments for higher or lower fees. And that'll be interesting to see how this develops further in both India and in the Eurozone.
Yeah, thanks. I mean, you already started to address, I think, Tobias, the last question. No, not the last, but anonymous here, about has the effect of transaction costs been studied on the adoption of these different payment services? So maybe the three of you want to talk a bit more about that one. And there's also, I think, in the same question, a link to the cost of setting up all this infrastructure, right? Which is from a societal point of view, obviously the right question to ask, right? I mean, even if we improve competition by some amount and maybe reduce rents for some American service providers, how much in terms of resources should Europe put up for that? Do we have any ballparks to think about these issues? So any of you who wants to think about those?
So this, of course, is one of the fundamental questions of welfare calculation. And so we'll not have any answer. But in India's case, what happened? We'll not have any precise answer. But the way I think about it is that in terms of the opportunity cost, that is, we are not doing this for free right now. So there is a whole lot of intermediaries rents that are being taken by moving money. I think Tobias or Ulrich pointed out that 1 to 2% of the friction, as I call it, the transaction cost of the payments that we are moving. So the intermediaries are taking a whole lot of rent. So any calculation of how much extra transaction cost or how much extra setup cost we are having should be computed against the present value of all those frictions. Okay, so and that is not trivial. We are not talking about as if we have a free system now and then we are incurring those costs. So at least in terms of the order of magnitude, if I start talking about 1% of the entire payment amount is intermediaries rent, and if I cut that intermediary rent, then perhaps some good things happen. So I would say this is a fair deal. But having said that, can we do that computation? Very hard. What happened in India's case, one might argue, is that the benefits of those three fundamental building blocks, internet, bank account, and identity card, went way beyond just the UPI. So from a societal perspective, what makes it really hard is that now, if you look at in India, the digital stack, as they call it, UPI is just one outcome of that. There are many other things that's happening. That is, for example, the government used to provide, still provides, not used to, but earlier, when they'll provide social security or some kind of benefits, not social security, but any government transfer, it used to be, if I might say so, there will be a lot of leakage or corruption in the process. Now, the beneficiaries are getting their DBT, as they call, direct benefit transfer. So that is happening because now from the government program to the beneficiary. So the point being, there are other externality. I don't have a precise answer, great question, but my gut feeling is that.
Ulrich or Tobias, do you have views on this question also about the societal trade-offs?
I can quickly try. I think in the case of India, as far as I understood, you know, the cost benefit from the society perspective is fantastic of UPI, because the huge, you know, inclusion effects, bringing, you know, all those people into electronic payments, very efficient electronic payments, and that's exactly what the paper of Amiyatosh is about. In the case of Europe, I would say, in principle, producing electronic money is cheaper than producing cash, and society is moving towards electronic payments. So I guess that the cost-benefit relationship also for central bank money moving, I mean, making this digital move is positive. Costs should be lower. I mean, it's true that also the European legislator wants to keep cash effective as well. So that basically enforcing the legal tender status of cash more effectively. So, I mean, there are some countries in the world which say we want the digitalization of payments. We will save, therefore, completely at the end the costs of the cash economy, let's say, of cash distribution and collection and fraud prevention, etc. So the Emirates, for example, have this explicit policy of digitalization of payments. But that's not in Europe for also societal reasons, like inclusiveness. Not everybody is able or wants to pay digitally. So therefore, let's say society via the legislator defines that to be an objective on its own, to preserve also the cash payment ecosystem with its costs. So that of course is then a different case. But if we believe in the ability of the legislator to identify those interests of societies and implement them via legislation, then maybe we should not question the wisdom of it. But that's how we are heading. But on the side of digital payments, I think they are cheaper than banknotes. That can be said now.
We have a question here also from Anonymous about India. There was talk about a digital rupee. What would be the differential contribution relative to the system that we have now of a digital rupee. And whatever answer you're giving now, Amiyatosh, that we can go back to Ulrich, of course, and ask him whether he feels that we rather should do something like India has done rather than opt for the digital euro payment system.
Well, this is more opinion, no research. So since we are asking about the opinions, I think in India, UPI has done great. And there are many, and there is, in India, for the digital, for the retail case of e-rupee seems weak now because of, again, the network externality. People have just, they're very used to this, the UPI system, it is working fine. Now, if you think about the large wholesale payments, I can see a case for digital rupee. But for the retail ones, I'm not sure, simply because this system has just taken off. Everybody is like so much of convenience, people are using it. So unless something breaks. Now, one thing that Tobias had talked about, which is everybody is talking about in India now, that interchange fees. So we had a great time for the last so many years, we as a consumer, because small transactions were more or less free, were free, not more or less. And now, once I start increasing the transaction amount, the volume of payment, then it starts attracting fees. So in that world, how the digital rupee versus UPI will work, it's very speculative at that stage. But the world that we have lived in the last 7-8 years, in that world, digital rupee didn't seem like the need of the hour.
There is actually some research I've seen, I mean, not from my side, but that looks at the adoption of the digital rupee. And it turns out it seems to be adopted as a response also to the costs on UPI. So for these types of transactions, people then switch to the rupee because it's actually cheaper. That was actually my first take on the readings of those who had analyzed this introduction, and I think it was 2023 of the digital rupee. I want to point out to one more thing, and I think this is cost versus innovation. And we've seen it with a decision in the European Union to require phone makers to have a uniform charging cable. So anything USB-C is now allowed in the European Union. And I think the idea is typically you can get costs down and grants from various proprietary charging cables. And now you can charge your iPhone with the same cable you can charge a Samsung Galaxy with, for example. Others have pointed out, obviously, yes, it decreases cost, but at the cost of maybe a less innovative, less dynamic system. And I think this will be also interesting for the digital euro to see whether not only costs can be brought down, but whether the same innovation level can be actually maintained. And my understanding from Ulrich's presentation was that exactly this is the target. But I think these types of implicit costs of maybe getting less innovation here and there, these are probably the true costs we might face because the pure operating costs, at least what we've seen from, I think, India and for Brazil, I've seen estimates, seem to be rather low compared to the benefits that these systems seem to bring. And the innovative part is obviously extremely hard to answer from a research perspective due to the obvious reasons.
If I can also quickly answer, make the link to digital euro of the question, if UPI, addresses all the policy objectives that also digital rupee would have addressed. So, I mean, we have in our retail payment strategy the objective to have a pan-European private, commercial bank-based payment instrument. And maybe what is the difference between, and there's an initiative, in the making called EPI, not UPI, but EPI, whereby the E stands for European and the U, I believe, for universal. But I know, so EPI, so what's the difference between EPI and UPI? EPI is really a private sector initiative of the banks and is not, has far less, top-down policy design from the central bank or from the, let's say, public authority. So UPI, I think, was designed largely by the public sector in a way, with welfare objectives, if you want. So including the fact that it was or is still for many transactions free of charge. I mean, illustrates that it was not, designed from a profit maximizing perspective of what, or at least from a, let's say, strong business perspective, while EPI is a private initiative, which, we encourage, but it is not, it is really designed, it's not, we are not designing it. So it will not be free of charge. It will be different from that perspective. Even if it ticks boxes from our perspective, it does not go as far as UPI as being, really strongly the design being strongly, controlled by the public perspective. And digital euro, if you want, is one step further than UPI. There we impose our policy objectives via the rule book that we are the owners of, even though we collect input and expertise from the industry. But the settlement layer is in central bank money. And you could say, yeah, in retail payment, the consumers or the payees in P2P payments don't care about the settlement layer because, the fact that central bank money in some scenario may be less risky and so on in payments doesn't matter, in particular not if you don't have to pre-fund and store it in advance. I mean, we see the following additional point that with digital, with CBDC, you preserve the coexistence of central bank money in the way it seemed to have served us well for a long time now. And, the architecture of money is in a certain way that commercial bank money is nothing else than a promise of convertibility into central bank money. I think that's what commercial bank money is. At every moment in time, I can get it exchanged into central bank money. So our take was that we should preserve this logic in full by keeping central bank money alive as well. So we go to the settlement layer, but I think it's a gradual, EPI, UPI, CBDC is, each of them achieves some policy objectives. And from this perspective, it's true to say that UPI makes the urgency of digital rupee lower because a part of very important policy objectives you have reached with UPI.
Thank you,
Yeah,
Ulrich.
to Ulrich. Yeah, absolutely, Ulrich, and I'll be quick. That my comment was to the extent of the retail transactions, retail payments. But if you're thinking about the central bank money objective, you're thinking about eventually the ability to pay interest on currency and things like that, then we have to head in that direction.
So maybe also related to these different design approaches, we have a question here from Alain Driancourt about compliance. So is there a sense in which, that's how I interpret the question, is there a sense in which maybe the CBDC model, the base layer model that Ulrich described would make it easier to enforce compliance than some other system, which is a bit on a higher level and relies more on private sector agents? I mean, is this a potential way to think about the trade-offs in that discussion, that architecture layer discussion?
Sorry, that was a question to me, Dirk?
Well, it was a difficult one. If you know the answer,
Yeah.
go for it.
Can you repeat it, Frank? Yeah, I didn't get it in the
the question is about compliance procedures and how digital payments can simplify the payment process. That's what I understand from the question. Is there a sense maybe that, say, the CBDC model is better or not as good able to address those issues?
I mean, the debate, I would say, for CBDC is around how to preserve privacy and anonymity, So a part of society is worried that the properties of cash, the unique properties of cash in terms of anonymity are lost if we move to digitalization of payments fully, or if we facilitate that by issuing digital euro. Other parts of society would be more worried about, or are more worried about the use of cash for illicit payments, for money laundering and tax evasion. So this is really, I mean, we as central banks can say it is for the legislator to guide us on this choice of society. It's a difficult choice, and I'm happy that it's not for the central bank to say. So I mean, the legislator has some sympathies for very high degree of privacy or even anonymity of lower value transactions. And there is the idea to put a threshold on offline transactions, which will be close to anonymous. But I would say, I mean, compared to cash, of course, every digital payment is more traceable, and whether digital euro relative to what we have now in commercial bank money as electronic payment instrument, I mean, there will be, I think, a bit more leeway for extremely private transactions, which implies, let's say, less traceability because of the will of the legislator and of society maybe to preserve some properties of cash in this respect.
Okay. We are basically done with our 90 minutes. So I would like to thank our three speakers very warmly. Ulrich from the ECB, Amiyatosh from Michigan, who actually joined us from LA this very morning, and Tobias from Goethe. The slides, again, we will make available on the CEPR RPN homepages, the two RPNs involved. And I thank all of you in the audience who joined us and commented and posed questions. Thank you very much to everybody, and have a nice afternoon.
Thank you.
Thank you.
Thank you.